So in this presentation, we are going to look at 14 lesser known financial ratios that can really help you to transform your financial analysis skills, or I can say that 14 underrated financial ratios that can really help you to improve your financial analysis skills. So the first ratio is cash conversion cycle. We may call it as CCC. What does this ratio says? This ratio assesses how long it takes a company to convert its resources, such as inventory, into cash from sales. A lower CCC indicates a quicker recovery of cash. What is the formula for calculating CCC? It's equal to days sales outstanding plus days inventory outstanding minus days payment outstanding. So simply you have to add sales outstanding and inventory outstanding, and you have to deduct payments outstanding. The second ratio is called as Altman Z score. This score predicts a company's risk of bankruptcy and is especially useful in evaluating financial stability of a company. What is the formula of Altman Z score? It's 1.2 times working capital divided by total assets plus 1.4 times retained earnings divided by total assets plus 3.3 times earnings before interest and taxes divided by total assets plus 0.99 times sales divided by total assets plus 0.6 times the market value of equity divided by the total number of liabilities. The third ratio is called as price to sales ratio, that is PS ratio. In contrast to the price to earning ratio, the price to sales ratio focuses more on revenue, making it useful for evaluating companies that are growing in sales but may not yet are profitable. What is the formula for calculating PS ratio? It's market capitalization of a company divided by total sales. The fourth ratio is called NOPAT margin. So the net operating profit after tax margin highlights operational efficiency, indicating how much profit remains after taxes. It excludes interest expenses. That's why it's called net operating profit after tax margin or NOPAT margin. What is the formula for calculating this particular ratio? It's NOPAT, that is net operating profit after tax divided by sales of a company. The fifth ratio is EVA ratio or economic value added ratio. EVA measures a company's true economic profit by taking into account the cost of capital, offering a better perspective than just the net income. What is the formula for calculating EVA? We have to deduct capital invested into cost of capital from NOPAT, that is NOPAT minus bracket capital invested into cost of capital, bracket closed. The sixth ratio is current liabilities to inventory ratio. The formula itself is self-explanatory. This ratio assesses how long it takes a company to convert its resources, such as inventory, into cash from sales. A lower CCC indicates a quicker recovery of cash. We have already seen this concept in the first ratio, so this is just an extended version for that. The seventh ratio is operating cash flow to sales ratio. This measures how much cash a company generates from its operations as compared to its revenue. It's a more reliable indicator than the earnings alone. So what is the formula for this particular ratio? Operating cash flow to sales ratio is calculated by dividing revenue from operating cash flow. The eighth financial ratio is free cash flow yield ratio. So free cash flow yield shows how much cash is generated relative to the company's market value, serving as a key indicator for valuation and financial health. The formula for calculating free cash flow yield is free cash flow divided by market capitalization. Ninth ratio is dividend payout ratio. This ratio indicates the percentage of earnings distributed as dividends, shedding light on a company's financial health and growth potential. What is the formula for calculating dividend payout ratio? It's dividend per share divided by the earnings per share. 10th ratio is the retention ratio. So what is the retention ratio says? It shows how much of a company's earnings are reinvested back into the business rather than distributed as dividends. The formula for calculating retention ratio is net income minus dividends whole divided by market capitalization. Next ratio is the cash flow margin. So the cash flow margin highlights how much cash is generated per rupee of sales, indicating the company's efficiency in turning revenues into cash. The formula for calculating cash flow margin is operating cash flow divided by net sales. Next ratio is gross margin ratio. So gross profit margin reveals how much profit is generated from the core business activities, which are the core essential business operations. But before operational and non-operation expenses are also considered. The formula for calculating gross margin is revenue minus cost of goods sold whole divided by revenue. Next ratio is the interest coverage ratio. This ratio measures a company's ability to cover interest payments with a higher value, indicating better debt coverage. Higher the ratio, better the debt coverage. Lower the ratio, lower the debt coverage. Formula for calculating interest coverage ratio is EBIT, that is earning before interest and taxes, divided by interest expenses. And the last underrated ratio is called as asset turnover ratio or asset retention ratio. This ratio reveals how efficiently a company uses its asset to generate revenue. A higher ratio suggests more efficient asset utilization. Formula for this particular ratio is net sales whole divided by average total assets. So with this, I conclude my presentation. Thank you so much.